The day after spot gold recorded an all-time record high, and that was at 2668.90. That was the record high AM fix, that is. Last Thursday, that was, which we illustrated also printed an all-time gold futures high at 2708.70. You saw that on the charts.
In gold, where we 100% target $3,000 gold, which is pretty much where all of the central bank, all of the first-tier banks are now targeting.
The only central bank still trying to hide the rate that the dollar is devaluing against gold. Now, it's not that gold's going up. It's just that the dollar's devaluing against gold.
Gold recently hit an all-time high, with the AM fix reaching $2,668.90 and gold futures peaking at $2,787. Central banks are now targeting $3,000 per ounce. However, this rise in gold isn't due to its inherent value increasing, but rather a reflection of the US dollar's devaluation against gold. While most central banks are acknowledging this shift, one still appears to downplay the extent of the dollar's devaluation. Andrew Maguire is a seasoned precious metals trader and expert known for his insights into the manipulation of gold and silver markets. He explains BRICS-facing exchanges, which are 100% physically settled, have learned to exploit the discount created by Western leveraged markets to acquire physical gold and silver. With an increasing number of gold and silver transactions being settled outside of Western exchanges, this shift is becoming unstoppable. The crumbling structure of the COMEX is exposing the limitations of the Federal Reserve's ability to manage the gold price against the dollar. Andrew says, as the foreign exchange gold markets and derivatives estimated at $70 trillion unravel, the Fed is left with two options: allow the COMEX to default, spiking interest rates, or revalue gold higher against the dollar. Andrew exposes that in the silver market, despite the metal being NSFR compliant, it has also been dragged lower. However, physical markets in Asia are increasingly setting the price, and silver is breaking out with the highest fix since December 2012. As central banks continue setting buy traps, volatility is expected, particularly with the upcoming Chinese Golden Week and a potentially politically influenced non-farm payroll report. Let's explore the video in more detail. If you're finding this content helpful, be sure to give it a thumbs up and subscribe to stay updated with our latest videos. Right now, only 11% of our viewers are subscribed. Help us hit our goal of reaching 1,000 subscribers by clicking that subscribe button.
And have learned to cannibalize the Western-facing leverage markets to alchemize this synthetic discount into physical. And because gold and silver price is increasingly being settled outside of the Western-facing exchanges, lines have crossed and this process is unstoppable. Now, the crumbling structure of the COMEX casino telegraphs the last tool for the Fed to manage the price of gold against the dollar is failing. And given that foreign exchange gold markets and related derivatives are estimated to be around $70 trillion when you add in all the derivatives, it leaves the Fed two choices: allow the COMEX to default, spiking interest rates, or to revalue gold higher against the dollar. And if we pop in and look at silver, again, this is October the 2nd, looking at silver, although NSFR compliant silver has also been dragged lower, the focus was clearly on trying to trick out as many CTAs holding 96% leverage gold futures bets as possible, really impacting silver. However, with far less silver flowing through London, the Asian-facing physical markets are setting the price. And if we pop onto the weekly charts and look and to eliminate the immediate chart chatter, we're most definitely seeing silver, as I say, breaking out. So note the highest fix since December 2012. That's not going unnoticed. This is also the breakout point where we've said that where the short stops exist. They've managed to pull it back a little bit, but really a breach through that, and we're now going to move into what we discussed last time, the 35s and then the 40s. And this explains the battle at the rapidly contracting December to spot contango, which is spot $32. The round, it's roughly equivalent in this futures chart to $32 is approximately 32.28, And we've seen that being gamed, but this spread is about to shrink. It'll shrink to either par or backwardated to spot by next month. So to illustrate just how stressed the cartel is finding themselves, we captured up to a 24-cent spot premium in the in-delivery October contract on Monday as Indian buyers lined up at the back door, a COMEX store, to load out their longs. We talked about these guys being very active in the silver futures markets because simply you can't trust anything that can move, because it's not NSFR compliant. Anything that UFP and EFP into London, you can't trust, can't trust remains as an unallocated position. So this means that all these positions that flowed out at 24 cents premium to this October contract that was expiring, they were underwater by $1,200 a contract. That's $1.3 million offside. And these are the little clues we look for. Now, as far as gold and silver are concerned, given Chinese Golden Week runs into a very likely a politically gamed non-farm payrolls beat on the 4th of October, on Friday, we should expect some additional short-term volatility, but this depends on where we identify where the central bank buy traps have been set. We've identified them a long time ago, and we laid them out for each one by one, they're being blown through. So 26.50 spot equates to 26.68 or thereabouts in gold futures. So into the scramble to mark spot gold bets to market sub 26.50, we've evidenced a large layer of waiting central bank sized limit orders being tagged, forcing commercials to back off generating downside momentum, which is what happened here. They were desperately trying to garner downside momentum.
Andrew highlights BRICS nations, through their gold accounts with the Bank of England, have been playing a strategic game in the global gold markets. With traditional dollar-bond correlations breaking down, the Federal Reserve is increasingly offside on its long dollar short gold bets. BRICS countries are positioning themselves to introduce a sanction-proof, gold-backed medium of exchange, shifting the international system toward a polycentric multipolar order. This will lead to more equitable trade relations and possibly a military alliance to secure peace, contrasting with NATO's current aggressive stance. Andrew tells the BRICS gold holdings, especially through the Sino-Russian alliance, now vastly exceed the encumbered U.S. gold reserves, allowing them to control the global gold price. Recently, this push has helped drive the price of gold to record highs, with gold reaching as much as $2,685. This process has already begun with the stealthy revaluation of gold since the Bank for International Settlements, BIS, reclassified gold as a Tier 1 asset in January 2023. As global central banks, except the Fed, accumulate physical gold, the Fed is stuck with an unaudited underwater position. A gold confiscation effort by the U.S. would likely backfire, potentially pushing the gold price to $10,000 per ounce, as it would prompt central banks to repatriate their gold from the U.S. Treasury. Let's get back to the interview.
Banks privileged to have gold accounts with the Bank of England so as to continue to play this lopsided asymmetric game. But as we've been pointing out, with traditional dollar bond correlations having broken down, they are deeply and increasingly offside. The Fed is increasingly offside on their long dollar short gold bets against gold. And they're undoubtedly in the process of folding their hand. So what is clear, with BRICS nations being able to take ownership of a sanction-proofed gold-backed medium of exchange, it segues into the forging of a polycentric system of international relations where we will see borders dismantled. Historical enemies will find it more equitable to trade, not fight, ultimately leading into a multipolar military alliance to secure peace in strength. The polar opposite of what NATO's aggression mandate is currently trying to do. And to give an idea of scale, even using the most conservative aggregate estimates of current BRICS nations' gold holdings, that's official and unreported monetary gold acquisitions, with the lion's share, of course, of this monetary gold is being accrued by the BRICS-related Sino-Russian Gold Alliance, which was established in 2013, but has waited for the fourth quarter to pull the trigger. Now, these unencumbered first-year physical gold assets vastly exceed the unaudited and empirically encumbered 8,000 odd tons of Fed-traded US Treasury gold. So as to easily control, I mean, it's so lopsided, they're going to easily control the global fiat gold price. Furthermore, with the BRICS nations having seized control of the physical gold price settlement process, it provides the BRICS nations an option of revaluing gold. The early process of this revaluation process is already underway by stealth. We pointed that out last time. Look at what's going on. Under the noses of the mainstream media, this stealthy gold revaluation process began the very moment the BIS strategically revalued gold as a first-year asset class, as I say, on the 1st of January 2023. And it was only after gold broke out above 2,000, as we saw when I demonstrated in the charts and looked at, that was in mid-February. It was only then that Bloomberg and the mainstream media deduced that the dollar price of gold was rising without attracting Western-facing EFP inflows. In fact, it was occurring into EFP outflows. And the mainstream media waking up to the fact that gold was rising, driven by global central bank physical gold demand. The Fed has been caught holding a massive, unaudited, rehypothecated, underwater gold position. There is only one solution: confiscation or a forced gold price revaluation. And given that the gold price is being globally settled outside of the US-facing markets, liquidity providers estimate a gold price confiscation effort would backfire against the PPT to the tune of at least $10,000 per ounce, as it would trigger every single central bank to repatriate every single ounce of gold loaned to the US Treasury.
The global gold market is undergoing a significant shift as central banks, particularly from BRICS nations, strategically increase their physical gold holdings, challenging the dominance of the US dollar. The devaluation of the dollar against gold, combined with the weakening influence of Western exchanges like COMEX, is setting the stage for a revaluation of gold. As gold and silver become more detached from Western futures markets, Asia's influence is rising, and the Federal Reserve faces difficult decisions. With the possibility of a gold-backed medium of exchange emerging, the future of global monetary systems may become increasingly multipolar. How might the introduction of a BRICS-backed gold exchange impact the current global financial system? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel first, and then watch the video, and turn on post notifications for more videos like this. Until next time.